everyone. Dr. Realtor here, and I'm going to talk a little bit today about the dreaded subject of taxes. Taxes is something that no one ever wants to talk about because pretty much when you look at the definition of taxes is a demand or a burden. Pretty much it is the heaviness that we all carry, but it's pretty much the amount that you have to pay to benefit. And taxes in real estate are paid in different aspects. Basically, when you buy a residential property, there is an amount of taxes that are paid every year. Sometimes it can be done, well, most times it's done monthly through your mortgage payments, and it has to be considered. We teach that location is the most important thing in real estate, but right alongside that would be taxes, because your location is going to determine your tax amount. And unfortunately, as newbies, sometimes taxes are not considered when selling or purchasing a property. I'll give an example. Even as a wholesaler, someone may think, oh, well, taxes is not any of my business. I'm still going to sell the property. Well, anything that affects the sale of your property is going to affect the sellability of that property. So that's why it's important to know and understand it. So today I'm going to talk a little bit about taxes. And what I wanted to start with was the basic, what is known as PITI, which is your principal and interest, your taxes, and your insurance. In that aspect, everyone who buys a property through a bank or lender has a mortgage payment. That mortgage payment is basically composed of your principal payment, your taxes, your insurance, and your interest payment. And the tax part of it is usually broken down into a monthly payment that is included in your mortgage payment. For example, if I have a $800 a month mortgage payment, and about $400 of that goes to my principal, which is the balance of the amount that was loaned to me. There's another $300, I believe, that goes towards my insurance. My taxes. And then there is about $100 that goes toward my interest. And then there is about $50 or so that goes to my insurance. So my payment of $800 is composed of all four of these aspects. And don't quote me, because of course the math is not exact in what I just said, but just to give you an example of how much goes towards taxes. In my situation, because of where I live, my taxes are almost as much as my principal payment. So you can probably understand from that aspect why it is so important to understand the aspect of taxes, especially when you're out here wholesaling a property or you're selling a property and you're claiming or making claim to a capitalization rate that is not realistic when it comes to the actual net on a property if you have not included a tax payment. You definitely cannot own a property without having to pay the taxes. Taxes are so important and so powerful that one can pay their mortgage company or pay a mortgage payment faithfully and pay a property off and still will have to pay taxes for the rest of your life, because taxes is something that does not go away. It is also important in the aspect of having a free and clear property and not paying taxes, and you will get what is called a tax lien, and that property can be taken away from you in a tax foreclosure. And in a tax foreclosure, or in a foreclosure period, any kind, taxes supersede the mortgage. For example, um, if there is a dual foreclosure process going on where the mortgage company is foreclosing for lack of payment and the taxes are foreclosing for a lack of payment, those taxes will supersede and can basically take that property before the mortgage company can. And it does not matter how much the taxes are compared to how much the mortgage is. I'll give you an example. If you have a $50,000 tax foreclosure and a $100,000 mortgage foreclosure, the tax foreclosure is going to take that property and will supersede that mortgage foreclosure simply because taxes supersede mortgages. So you can see how powerful a tax payment is and how important it is. And that's why I wanted to touch on it today, because it is one of the basics of real estate um, things that I wanted to touch on, that you need to know about real estate when you go into it. Um, when I research a property or when I go out to invest or look at a property, the first thing I look at, for me, a strong selling point is the taxes and the school system, because of the environment that I buy in, or some of my clients would buy in. Those are the most important aspects, because those can be uh, two of the greatest selling points, or deal killers. An example I can give you that I just had recently. There was a beautiful property that came up as a foreclosure, and actually it was foreclosed upon, which means it has already gone back to the bank. But it had a $14,000 a year tax payment. Now that changes the game completely. Um, just give you an example. Say this property could have been obtained for $120,000, and there were individuals who were ready to pay and had qualified for that $120,000 mortgage, but by no means could afford a $14,000 a year tax payment, which would equal out to uh, just over $1,000 a month. So can you imagine thinking that you had a property and you would be able to afford it at maybe $800 or $900, and then getting an additional $1,000 added on to that payment? So you see why taxes are so important. And as a sales agent, as an investor, as a wholesaler, whatever your role is in real estate, these are the things that I felt like needed to be taught and needed to be made aware of. So that's one of the reasons why I'm doing this Basics of Real Estate class, because I want you to know and understand some of the things that can make or break a real estate deal. So that's why we're talking about taxes today. Another aspect of taxes would be the taxes as far as when you buy and sell a property. You are responsible for something that is called capital gains. Now, whether you are a wholesaler, now I'm not giving tax advice. I'm not an accountant. I'm not a lawyer. I'm just simply a retired real estate professional that has 30 years in the business. So I'm here to give you my experience for educational purposes only. Okay, so when you buy and sell a property, you have something called capital gains tax. In order for you to make that property sale profitable, you have to consider this prior to. Whether you're a wholesaler, whether you're an investor, whether you're just a homeowner who moves from one primary residential property to buying your second, or buying a investment property and selling your original, you need to understand that there will be taxes that have to be paid. There are several ways to diminish and avoid those taxes. And there's enough information out here for you to look and find out about that. But I'm just going to sum it up really quick. When you own real estate and you have real estate investment property, there are a lot of people out here teaching the BRRRR method, where you buy a property and you rehab it and you refinance it and rent it out and repeat the cycle again. But today's situation currently and futuristically will prove that not to be a good idea, especially at a time when people are not paying rent right now because of the moratoriums with evictions and foreclosures and things like that are going on. So my suggestion is this. You never drain a property of its equity. I think that is the silliest thing I've ever heard. And it's just my opinion. Like I said, 30 years in the industry, lots of experience, have had over 50 some odd doors myself, and it's just my opinion that you would never, ever drain a property completely and then sit back and depend on someone to pay for that for you. The smarter thing to do, which I've seen myself to be very successful, is to basically build wealth over time. And the best thing you can do is to set yourself up in a situation where you are reinvesting any monies that are taken out of a property, and never ever take out more than a 60 to 65% loan to value situation, so that your equity is not completely absorbed and you're sitting back stuck at a time like this where you can't even refinance, and at a time like this where they're not even allowing so much, a limited amount of cash out anyway in a refinance. So my suggestion is to know and understand the tax laws, read and really understand the process of benefiting from property depreciation, cash flows, and the aspects of real estate that will keep your taxed amounts at a minimum or zero, as they can possibly absolutely be as an investor if you know what you're doing. Receive the benefits from rolling those amounts of capital gains into a IRA, tax-free, as long as you do not take it out and you keep it in. And right now there's some situations that are beneficial during this time of crisis, that you can actually take it out, use it, and return it within a 3-year period. Something you may want to look into. But just having the knowledge to be able to reinvest those dollars so that you're not paying full taxes on that money. You'd be surprised how many people are super or have experienced super wealth and have lost it to taxes, just out of sheer ignorance of not knowing what to do with that money once it is received, and then being stuck with a huge tax bill at the end of a work period or a year of earnings, and just not planning. So I say this to say that planning ahead of time and knowing and understanding cash flows, depreciation, property investment properties, and knowing ahead of time before you receive money what it is that you're going to do with it. Money is a tool, and it is a tool that, if not used properly, can be detrimental. I am by trade also an electrician, and there are times when I have to always respect the electricity. If I make a mistake and think that I have turned the power off in a situation and stick a screwdriver into a plug or a light switch, I can pretty much get electricity going through my body. And that would not be a good situation. So just knowing, respecting, and planning when you're dealing with money and taxes is my suggestion. Um, Also, I wanted to talk about the fact that structuring the entity in which you're receiving funds from will also benefit you as far as your tax payments go. Um, there is a huge misconception um, that I see a lot of investors holding properties in LLCs. Like I said, not an attorney, not a lawyer, not an accountant, just here to give you my experience. And it is so much safer as far as the anonymity of owning properties through a trust than it is through an LLC. Now, don't get me wrong. Forming the LLC is a there are great opportunities for you, but the properties, in my opinion, in my personal opinion, should never be held in an LLC. They should be held in a trust. Now you get people out there saying, oh, there's these benefits where blah, blah, blah. You can still benefit tax-wise holding a property in a trust. You can still benefit from the mortgage 1098s. You just have to know what you're doing. So I say that to say that the way that you form, the entity that you form to receive funds should also be very closely considered so that you maximize your tax benefits. I did not know in the beginning of my career that proceeding as a self-employed individual would cost so heavily when it comes to taxes. Self-employed individuals pay the same as wage earners, 30 to 40% tax bracket that can be very detrimental. There are people who make $1 million a year that are doctors and lawyers and then turn around and pay $300,000 and $400,000 a year in taxes. I'm sorry, but that is not a smart move. Whereas as an investor, you can make the same amount of money. And I have been in those situations where I've sat in front of or amongst individuals who had made the same amount yearly as I did and simply could not believe that there were zero taxes paid as an investor compared to their $300,000 and $400,000 a year as self-employed individual. So knowledge is power. I do not have anything against paying taxes. It's just that why would you have to pay more than what you need to for your hard-earned dollars when you're out here contributing to the economy just as an next person? So it's just a matter of having the education and the wisdom and the know-how to basically choose the right entity to receive your earnings from, or in, I'm sorry, and knowing how to structure your business so that you can maximize the best tax benefits. And I'll just say that again, that investors pay anywhere from 0 to 10% taxes, whereas a self-employed individual or sole proprietor has to pay anywhere from 30 to 40%. So you do the math, which is more beneficial, which is going to be more profitable, and cause less problems in the long run. So you just have to make that decision prior to and move forward. I think that was pretty much all I wanted to touch on today as far as the taxes go in real estate. There's a lot of information out there on YouTube, Instagram. You can pretty much find out what is available to you by basically doing your research, getting your wisdom, staying focused, utilizing this time to get educated. I'm always pushing education. I've been in education for over 20 years, had my own real estate school, and I absolutely love learning. So I commend you for those who are out there searching and reading and learning. As my sister Lynn Richardson says, get a home-based business. Um, relieve yourself of ridiculous tax amounts, and utilize those benefits. She preaches 100% all the time about hiring your own children, receiving that $12,000 tax credit from doing that, um, developing the proper entity to basically benefit from taxes to the fullest. And as far as real estate goes, making sure that you utilize your investor tool and your investor hat to benefit from those the depreciation of having rental property, and utilizing those capital gains to basically deposit into an IRA or a self-directed IRA or 401k, and diminishing your tax amounts that way. So thank you for listening. Like or subscribe the video. This is Dr. Realtor signing off. Be blessed, be safe, wash your hands, stay in when not absolutely necessary. No matter what the news tells you, it is better to be safe than to be sorry. Thank you. Be blessed.